Hey, and welcome back to a new video. Today we talk about moving averages, how to use them in your trading and the different purposes for moving averages. So first of all, I use in this chart a 20 and a 50 period moving average. I always recommend using two different moving average, one with a lower setting and one with a higher setting, because this combination allows us to use moving averages very nicely and effectively. So the first thing that people always look for when they use two moving averages is they look for the crossover. So for example here, the black one, which moves faster than the blue one, is the 20 period moving averages, and the slower one is the 50 period moving average. And whenever you have a cross, when the slower crosses above the faster moving averages, it means that the dynamics in trend and in trend structure have changed. So in this case, once the moving average cross each other, then you would enter a long position, or you would get potentially the signal of a long trend. But at the same time, you can see here before that, price was in a range. So this is important to understand that when price is in a range, that the moving averages are not that meaningful. You can see price overshot the moving average here, because as the name says, a moving average is the average of past price action, and a range by definition is a sideways moving market, so the moving average will always be somewhere in the middle of a moving average. And you can see here not a lot of reaction or respect, but once we start trending it again, then the moving average work nicely. So when you come out of a range and then you have the cross, I always suggest that you also use regular and standard concepts of support and resistance. So for example here we could have drawn something like a trend line or a channel, and then although you have this this cross here of the moving average, then you would wait for the break and then you could enter your trade. But this is a bit more advanced, and I just wanted to highlight the importance of seeing the differences in moving averages between a range and a trending market. And so the first thing, as we said, is the crossover in the moving average. So once you see the cross of the fast moving averages above the slow, then you can get the signal that the market is changing into an uptrend. And then on the other hand, once the faster moving average crosses below the slow moving average, then you can see here price then started its downward trend until the other signal was given in the other direction here. Once the moving average again crossed each other, then you had a short uptrend. But here we have been recently in this range, and as we said again, ranges are not very good for moving averages, because the average will always be somewhere in the middle of the range. And this was also true here. We had this range, here was the moving average without much respect, and so during a range we don't use our moving average as much. The next thing that I use a moving average is that I time it for my entries. So I only use the 20 period moving average, and maybe you know it, I'm a reversal trader, and I always look for those transitioning periods where we go from the uptrend to the downtrend, or from the downtrend to the uptrend, and I use the filter, the moving average, as my filter. This is I got this from the book called Pitbull Trader from Marty Schwartz, who said that his moving average is this red light, green light indicator. So you only take long trades when price is above the moving average, and once price is below a moving average, then you only take short trades. And I don't enter reversal trades before the moving average, so this is something that helps me get in the trades a little bit later. And although this sounds not good, because most people say that you have to catch the top and the bottom, this is not true. So for example, let's say we were in this uptrend and then we were looking for shorting opportunities. Most people will short along the way. They will short here, 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 and then they will have a very big loss because they are trying to predict the reversal. But once you add the SMA or the 20 period moving average to your charts, then you would only short once price breaks the moving average here to the downside, which gets you in the trade a little bit late, but it's a very safe entry and you avoid all those premature mistakes that you get here. And then on the other hand, Once you are in this downtrend, you can see price made a few attempts to break the moving average, but it never really succeeded. Here as well, and then here we then entered this uptrend. So the 20 SMA is a very good first filter. Although it's not a standalone trading system, it can help you stay away from a lot of losing trades. At the same time, you can use the moving averages for your stop trailing. So once I'm in a short or once I'm in a trend, then I move my stop loss. Just let's say we entered a short here after price broke the moving average. And then when we are short, we can use the 20 SMA to trail our stop loss. A good rule of thumb is that you don't place your stop right on the moving average, because you can see price up from time to time tries to retest the moving average, which is a very common behavior during trends. So first of all, you always add your spread to your stop loss, and then also you give it a little bit room. Depending on the pair and the volatility, you have to change the amount of padding that you give your stop loss, but that's something that you pretty fast get a feeling for. And so here as well, you can see that during this uptrend, we were able to pull and move the stop loss along the 20 SMA very nicely. And then once price broke it, then we could have exited. Or if we got other exit signals, we could have maybe exited somewhere around the top. But again, it's not important to call the top and the bottom, but to take what is safe in between. And the moving average helps you there very nicely. And finally, because we are using two moving averages, one fast and one slow, we can use this information to analyze momentum. So this means that whenever you see two moving averages away from each other, it tells you a lot about the momentum that is going on. So when you have moving averages that are close to each other, then the momentum is not as high. But then you can see that when the moving averages pull away from each other, it means that the trend is gaining strength and is becoming stronger. So you can see here that already the moving averages are coming closer to each other, that it was obvious that some trend change or trend change behavior might occur. Here as well, price started to move lower, and then at the same time, the moving averages came closer. So the distance between the two moving averages also tells you a lot when it comes to trend strength and trend momentum. And that is basically how you would use moving averages. So first you can look for a cross as a first signal. Again, a cross alone is not a good enough entry signal, and we would combine it with different tools. But it's the cross highlights that something is changing in the price structure. Second, don't use moving averages when you are in a range and you have clear and well-defined boundaries. Only use moving averages during trends. Third, you can use moving averages to time your entries. You can use them as entry filters to get in a trade a little bit late, but at a much safer place. Fourth, you can use moving averages to trail your stop loss during trades and to manage your positions. Because moving averages always work, and not always, but they often work as very nice support and resistance, because so many traders use them that it's like a self-fulfilling prophecy, and it's worth having moving average on your charts, especially the most commonly used one like the 20, 50, the 100, the 200 and the 250 on the daily chart. And that's basically how you can use moving averages in your trading very effectively.